The key attractions to our approach to infrastructure debt for investors are from a couple of key factors. The first is the stability in earnings and cash flow generations and general credit quality of the infrastructure assets. The second is the long duration profile under a lower rate environment. The underlying issuers in the infrastructure sectors are generally providing essential services. Think of utilities, telecommunications, energy, and so on. In general, that supports stability in earnings and cash flow generation, and in general in credit metrics. Even during periods of economic slowdowns, many of these sectors can be expected to continue to generate steady results. The strategy specifically owns only investment-grade debt issued by developed market companies in investing. The historical experience is that default rates are low, even over periods that capture some material economic disruptions. Aligned with the stability of cash flows and long-dated asset lives, infrastructure companies are able to raise longer-dated debt. Longer-dated bonds tend to have higher yields than short-term bonds and can be more aligned with investors who have a long-term investment horizon and can provide stability in long-term income. One of the characteristics of long-term bonds is their high sensitivity to interest rate fluctuations. Therefore, long-term bonds are expected to benefit from rising bond prices, especially during periods of falling interest rates. Generally, it performs well in periods of higher yields, of falling yields, and of stable or slowing economic growth and inflation. We are currently in a high interest rate environment, and a decrease in the long-term interest rates is expected in the future. Infrastructure bonds are at a turning point and continue to show a positive outlook. This can align with an investor with a long-term horizon. The main sectors of the strategy are energy, transportation, communications, and utilities. Starting with the utilities sector, this sector provides essential energy to households and industry, primarily electricity and natural gas, and companies in this sector can be involved in different parts of the value chain, from generation of electricity to transmission and distribution, or can be fully integrated. These companies provide essential services for daily life. Many of these issuers are highly regulated, and they tend to generate stable cash flow over the long term. The stability of cash flow and revenue is one of their key attractions. For the energy sector, the energy issuers provide a variety of products and services, from exploration and production to refining of crude oil. The pipeline sector is focused on providing infrastructure to transport energy products, such as crude oil, gas, and refined products. These sectors again supply crucial energy to the global economy. Issuers in the energy sectors can be more cyclical, and the attraction of this sector for the strategy is that they generally offer a higher yield for the strategy. Moving to the communications sector, these issuers provide communications and infrastructure for consumers, businesses, and governments, with the major sectors here being telecommunications, cable, and media. There is an increasing demand for high-speed, stable telecommunications infrastructure, and long-term contracts with telecommunications companies ensure stable revenue and cash flow. Diverse, and the attraction for the strategy is the high-quality nature of many of the largest telecommunications providers, which offers both yield opportunities and stability to the portfolio. The transportation sector is most heavily weighted to railroads and transportation services. These issuers provide transportation for freight for both businesses and consumers. The US railroad network is the largest in the world, moving bulk commodities as well as containers that can be transferred between different modes of transportation, such as ship to railway to truck. The attraction of this sector is its stability, offering long maturity bonds with stable income for the strategy. Among the four sectors, global infrastructure bond has relatively large positions in utilities and telecommunications sectors. Let me explain the reasons for this. For the utility sector, we are seeing expectations build for significant growth in demand for electricity over the coming decades. This is a new factor, as the total generation of electricity had not really changed for about 25 years in the US. But now, growth is expected to be driven by multiple sources, including AI and cloud data centers, manufacturing, and electric vehicles. Expectations for AI is one of the largest impacts. A single large data center can use as much power as a small city, and there is strong demand to build new data center capacity. This needs investment, which builds upon the investment cycle already underway to support the greening of the grid. This means there's much more certainty in demand, and customers have shown they're willing to enter long-term contracts to ensure supply. This should be a tailwind for the sector for the long term. In communications, the subsectors are going through different stages of the cycle, and our positioning reflects this. In telecommunications, this sector went through an investment cycle with the rollout of 5G a few years ago, and now has been in a period of delevering over the last several years. The competitive forces in this sector are also less extreme. All of these themes are positive for credit investors. In cable, however, the sector is dealing with a large capex spend outlook to upgrade the network and compete with fibre, and gradually declining video subscribers. We think the outlook for cable is challenged, but some issuers in this space have made moves to delever their balance sheet, and some offer attractive yields. The media sector continues to experience headwinds from a weaker advertising market, heavy streaming losses, and declining cable audiences. We believe these forces will remain for some time. We think AT&T is one of our favourite companies. AT&T is in the telecom subsector in the communications sector. And as of the end of September 24, this fund holds one of the largest exposures when aggregating the portfolio holdings across issuers. AT&T offers consumer and business telecommunications, wireless and 5G networks, as well as specialist dedicated networks for sectors such as first responders. They're also the largest provider of fibre broadband in the US and have been investing in this part of the business. In this, they've been a leader and ahead of some of their key competitors who have had to go more of an acquisition-led route to expand their fibre offering. What we like about this sector is that it is past the peak investment required for the build-out of 5G. That investment was significant, contributing to over $140 billion of infrastructure investment for AT&T alone. And now growth in revenues and earnings are allowing the companies in this sector to delever. This is good for credit investors as it reduces credit risk. There is still significant capex as the sector continues to expand and maintain its network, but the sector generates strong free cash flow, and competition generally has remained rational, with strong pricing gains. AT&T specifically has simplified and focused its mission in the last several years, focusing on owning and operating the infrastructure of the network. This is a change from their history. They had acquired media business Time Warner in 2018, adding a large media business to their broader business. But they exited that business in 2021, which allowed AT&T to significantly reduce its debt load, sell assets, and simplify into a core business without the distraction of a media business. Most recently, the company sold its remaining stake in DirecTV, a satellite TV operator, which marks another step in focusing and simplifying and selling assets. AT&T has grown its earnings, generates strong free cash flow. It has also reduced its debt sharply in recent years, which fits into our strategy of owning companies with stable fundamentals and strong credit profiles. AT&T has also offered attractive yields for its BBB credit profile and continues to be one of the largest positions in the fund.
So to provide a quick summary of the election outcome and its implication for markets. Firstly, obviously Republicans have won both the presidency and control of the Senate, and it appears very likely at this stage that they'll win also control of the House and Congress. The result was clear-cut, with Trump improving on his 2016 performance, including winning the popular vote. Again, betting markets in this case provided a better prediction of the result than polling, which had suggested a very tight race. As always, the implications that we're talking about here for infrastructure bonds in particular are dependent on how these policies actually get implemented. Firstly, the overall impact on markets. The knee-jerk reaction was for Treasury yields to rise and for the curve to steepen, for equities to rise very sharply, and for credit spreads to tighten across almost all sectors. That was driven by expectations for pro-growth policies such as deregulation and lower taxes, but also for potentially higher inflation due to tariffs and tightening immigration. The moves in the last couple of days in the bond market have reversed some of that initial move higher in yield. The sector implications for infrastructure issuers that we see at a very high level are as follows. Firstly, on energy, Trump will clearly be more supportive for domestic production. His tax policy should be supportive for earnings. But in the medium term, more production increases oil supply, which should limit oil prices. For pipelines in particular, we expect expanded production to support the pipeline sector, and deregulation and taxes also to be a positive. For utilities, we expect the Trump administration will work to weaken some of the environmental policies that have been introduced in the last several years, which have provided tax benefits to renewable energy producers. Overall, this is a negative for some of the utilities developing large renewable projects. On transportation, we believe easing of emission standards, tax cuts and broader deregulation will support the sector by reducing operating costs. For most other sectors, tax cuts proposed would be a small positive, but generally the impact of the election is likely to be a neutral impact on overall credit quality.
We continue to view the medium-term outlook for the economy as an environment where inflation continues to gradually cool back towards central bank targets, and the growth continues to gradually slow. This environment is generally good for high-quality bonds, as lower inflation and steady, slower growth should lead to tight credit spreads and lower bond yields in the medium term. The risk to that outlook would be that inflation remaining stickier than its current trajectory. This would increase bond yields and prevent central banks from easing monetary policy. We are monitoring this risk but do not currently see signs that this is the case. Overall, we think with much higher yields on offer and the potential for lower yields in the medium term as inflation and growth cools, it continues to be an attractive environment for infrastructure bonds.